Yes, you read the title right. I am financially independent. Today we're going to talk about what exactly that means and how I managed to get here. So 3 years ago, I set a goal to become financially independent. And by that, I mean to have enough investments put aside so that I can withdraw every year enough money for me to survive on. If you want to know the details of what I need to survive, I do have a video specifically outlining how I came to my financial independence numbers and my basic yearly expenses. When I initially set out the plan to become financially independent, my goal was 5 years based on my projections, but I managed to do it in 3 years, which is kind of shocking. Most of that has to do with the stock market. I'm not going to say that it is of my own doing. like If it was of my own doing, without the stock market, it would have taken probably 5 years or even longer, but the stock market definitely helped. So how I like to do these, I've done this every year for the past 3 years. I usually go over my stock portfolio based on categories such as retirement, brokerage account, etc. And I compare it to the previous year. And we can see the difference between each year. And then I give you a total amount of how much money I have invested in the stock market. So that's what we're going to do. And then after that, we'll chat about my theories as to how I manage to do this. Some of them are theories and some of them are like things that are tried and true that I've been doing and talking about for years on this channel. So yeah, let's get started. So I order these accounts in the way that I invest in them and how I suggest most people invest in them as well. And it's not basically just my suggestion, it's just sound financial advice that has been said over the years time and time again by various financial experts. And I would agree. In terms of maximizing tax liability and benefits, this is probably the best way to invest your money. So that order is your retirement account, so 401k, 403b, followed by a health savings account if you happen to have one of those, then a Roth IRA, and finally a brokerage account. So starting with my retirement account, as I said, there are 401ks, 403bs, that type of thing. In 2022, I had $131,974 in that account, and as of most recently, I have $212,005. So the difference between last year and this year is that I gained $80,031. Now, in terms of the retirement accounts, in terms of the money that has accrued in there, that makes a bit of difference. One, of course, I maxed this out. I've been maxing it out for the last 5 years. So ever since I graduated graduate school and had a steady job, I have maxed it out every year, and I maxed it out last year as well. So it includes my contributions, my employer match. Where I work has a very generous match right now, so I'm sure that helped. And I've gotten matches and bonus payouts from my other employers. I have had several employers during the last few years, and I have retirement accounts at each of them, so that has happened. And then of course lots of them pay dividends, and then there is the investment return, so the increase in the market value of whatever stocks I have in there. So I will say that most of my investments are in stocks. The retirement accounts only have exchange traded funds in there, which are basically baskets of funds such as the total US stock market. So all the companies that make up the US stock market are in that particular fund. So that is what I have in my retirement account. So $80,000 is a good amount of money. I know for sure that $22,500 of it is my money, and the rest are, of course, increase in the stock prices, dividends, and then the employer match. Now, it's much more than I had expected. I was quite shocked to see that difference, but I think I just happen to have picked like the right stocks for the time, because as you know, as of most recently, the stock market is on an upward trajectory, particular because of the technology sector and the artificial intelligence boom. And I have a good amount of technology stocks as well as the S&P 500. I think at least 30% or more of my retirement accounts is in those two sectors of the market. it. So I'm sure that helped a bunch. Moving on to my other account, that is going to be the HSA or health savings account. So I have not contributed to this health savings account since I last had it, which was, I think, 3 years ago now I've had it. So there have been no contributions because I no longer have a health savings account plan. So you need to have a high deductible insurance plan in order to use, and I no longer have that insurance plan, so I cannot contribute to it anymore. But I have everything in there invested in exchange traded funds, and last year it was $8,225, and this year it is $9,083, making a difference of $858. So I will say that prior to 2022, so in 2021, this was around 9,000. So I lost money last year and then I regained some of that money this year, which is basically what happened. So that's good. Hopefully I regain all the money that I lost. I don't think I've regained all of it. I'm missing like a few $100, I believe, but still I'm happy to recoup anything. Moving on to Roth IRAs. So similar to the retirement account, the majority of this money or the contributions are mine. So I think the contribution is $6,500. So every year I contribute $6,500, and like I said, I've been doing that for like the last, actually it hasn't been 5 years, it has to be less than that, because I spent the first 2 years after graduate school paying off my student loans. So I did the very minimum in terms of investing, and then I went heavy in the last 3 years. So the last 3 years or so I was able to contribute to my Roth IRA, and thus the starting balance in that account was, well, not the starting balance, but the balance from last year was $42,670, and this year it is $52,816 with a difference of $10,164. So like I said, 6,000 or so of that was my own contribution, and the rest were investment returns and dividends. Same thing for the HSA. There are no matches. I know some HSAs you can get a match from your employer, but this one I never did get a match, and clearly I'm not with that employer anymore, so I wouldn't have gotten a match anyway. And the final set of accounts that I have with investment funds in them is the brokerage account, and that is where I put the majority of my money. So any money that I do not use on a monthly basis to fund my cost of living or for savings categories that are not investments, then I put it in this account. And of course, I've been historically heavily investing in this account for the last 3 years because of my goal to become financially independent. I did stop at the beginning of this year because I went part-time, and as such I did not have the extra money to contribute to this account. So for the beginning of this year I didn't contribute much to it, but for the majority of last year I did put all my extra money into it. So starting in 2022, I had $167,681 in that account, and this year I have $229,777 with a difference of $62,096. So that's a pretty good amount of money, I would say. Actually, I'm not sure. I would need to look into like how much I put in versus how much the market has contributed to this, but I would say majority of it is probably from the market, because like I said, a lot of the stocks that I have are technology focused stocks and high growth sector stocks, so that probably helped there. And even then I think I am still missing some money. Like I have not recouped all the money I lost last year, so there's that. But of course, like I said, I'm happy to recoup anything, so that's pretty nice. No, I would say I didn't expect to become financially independent so soon, because last year around this time I had $350,550, and as of most recently I have $503,681. So that is a difference of $153,131. So that is a good amount of money. Like, definitely not from my own contributions. As I've said, it's definitely because of the market. So I was not expecting the market to necessarily rebound this year. Eventually I expected it to rebound, but not this year and so quickly. So I was quite surprised when I logged into my account and saw that I was financially independent. So that was pretty amazing in that regard. So yes. Now let's talk about what I've been doing these last 3 years that have helped me to achieve this. So first things first, in order to achieve any savings or investment goal, you probably need some sort of income, unless you are already wealthy from inheritance, which means you've already achieved what you need to achieve. So you need income, and I historically, since I've graduated graduate school, my degree has allowed me to earn 6 figures. Now I know 6 figures is vague because it means anywhere from $100,000 to $900,000. And I am definitely closer to the $100,000 mark. I would not say it is average because most people don't make that amount of money, but it is average in terms of 6-figure incomes. So income is a huge part of what allowed me to save this much money, but the most important part is the savings rate. So that is the amount of money that you are able to save versus spend. And I, over the last 3 years, have saved at least 50% or more of my income. Now, 50% is, if you're trying to maximize your financial independence goals, is a great amount because every half of your income that you can save is another month that you can live without working, another year that you can live without working. So it has great implications. And of course, that is multiplied when you invest that money. Then you can not work for even more and more years. So the higher you can get your savings rate, the better things will work out for you automatically. And I managed to do that, and we're going to talk a little bit about how that is. So I managed to do this, or to have a high savings rate, because I live in a very low cost of living state. Now, I'm sure people know of high cost of living states, which is New York. That's consistently a high cost of living state, as well as California. Those are the two ones that come to mind in terms of high cost of living. Low cost of living states are usually states that are not particularly desirable. Like, the reason New York and California have such high cost of living is because they're very desirable. They have great weather, as in California, or they have great amenities or things that people want, or they have terrains that people want, so beaches, mountains, etc. Now, other states that don't have those things are not particularly desirable, and thus they have a low cost of living. So that's part of the reason. I'm sure there are other reasons as well. So I live in the Midwest, which is not particularly desirable because there's not much going on there, which I like because it's just nice to be low-key, relaxed, and not having to deal with all the people in the high cost of living state and all the other things that come with having a higher cost of living. So because of that, I have very low housing costs, which is the majority of most people's spending. And because of that, I can save a good amount of my income. Another key part of this is, of course, investing. You have to invest the money in order to see decent returns. Up until recently, you could not see these returns in, say, a checking or savings account. Nowadays, you can get about 4 or 5% return, which is very good, and everyone who is able should get a savings account with that rate of return. But prior to this, it was very low, like 1% or lower. So in order to maximize your money that you're saving, it needs to be invested and compounded over time. The other thing that I did is maximize my contributions to every account that had a max. So retirement accounts are 401k, 403b, I maxed those out. And when I had an HSA, I maxed it out, and the Roth IRA, I maxed that out every year. So you want to do those because those accounts are usually tax advantaged in some way, and those accounts, you need to be putting them in investments, of course. So maximize your contributions, and then if you have extra money left over, you can invest it into a brokerage account. The other thing about me is that I prioritize saving or paying myself first. So that means sometimes even before I get paid, because of course the retirement contributions come out before I get my paycheck, but even immediately when I get paid, I put money aside for savings and I spend the rest. So that means regardless of how much I choose to spend that month, my saving is already put aside. So sometimes that means if something comes up, sometimes I don't have enough money for it specifically. I do have sinking funds for things to avoid that, but sometimes I just don't have enough money for something that I want to buy, and I don't buy it because I have already put the money aside for savings or whatever other goals I have, and that's just a fact. If you wait until after you spend your money to save, then it becomes very difficult because you'll always find something new to buy. So it's better to just pay yourself first, put everything aside, and then do what you can with what you have remaining, provided of course you have an emergency fund, etc., for things that come up. But that is one way I managed to save this amount of money. Another thing that I did was to pay off debt. I think I mentioned in the beginning that in the first 2 years after graduate school, I prioritized paying off my student loan debt because the interest rate for that debt was the highest was around 6.8%, which means that I was paying 6.8% of my debt total to the government versus receiving 6.8% from investing. So it made more sense to pay the debt off before I started investing. Now I know people have different ideas of this and believe that you can do both at the same time, which you can of course, but to me mathematically it made more sense to pay off the debt and then invest later. Of course, in terms of retirement matches, you want to put the minimum to get your retirement match because that is something that you cannot regain at a later time. But outside of that, I think it's best to pay off your debt and then invest afterwards. And the last thing that helped with becoming financially independent is of course time, which is the hardest part, or one of the hardest parts, I believe, because I'm impatient. I think most people are impatient. Like nobody wants to be waiting around for years to become wealthy. But unfortunately, that's how it works for the regular person with a 9-to-5 job. It takes time. However, in that time, lots of great things can happen in terms of compounding of the money that you have put aside in the beginning. When I started, it felt like it would take forever to get any amount of money. I know when I saved my first $100,000, that felt like forever. And then I think the second year I actually managed to double that amount of money because that is the beauty of compounding. Once you get a significant amount of money, the longer you have it, the bigger it becomes. Sometimes even if you don't do anything with it, it can multiply exponentially because of compounding. So time is of the essence, as they say. Just know that it's going to take time to get to where you need to go. So try and enjoy your life in the meantime and not think so much about the time that it's going to take, because that is something that can trip you out. Because I know for sure, like I was very impatient with the time, and when I stopped thinking about the time, then here we are. It magically happened. So yes, that is going to be it for this video. Of course, if you have any questions about what I've mentioned at all, feel free to leave them in the comments below. And of course, I will leave a link to my financial independence playlist so that you can learn more about what I'm talking about today.